Greetings and welcome to you all to this ISTAT Learning Lab, where we're going to be discussing aviation capital markets. My name is Peter Negline. I'm an ISTAT board member based in Australia. Just proves that ISTAT really is international. And I'll be one of the hosts on today's call. I'm also joined by Jian Zhu, who is based in Hong Kong with Alton Advisory. Jian is an ISTAT certified appraiser, and she will moderate the audience Q&A at the end of the call, and we'll wrap up things from there. Today, we're fortunate to have with us three leading analysts and commentators on global aviation credit markets. So it's a great opportunity for the live audience to pose questions of our esteemed members on today's panel. Now, the genesis of today's Learning Lab is a carryover from a continuing education session that was arranged for the ISTAT appraiser community earlier in the year. So Jian and I will effectively just be sitting in the background and leave our panelists to conduct a discussion amongst themselves, considering they're the subject matter experts. The real matter today, the real moderator today is David Berkowitz, who founded Radar Asset Management in 2011. David consults independently on aviation financing, investment, and strategic issues. Now, prior to Radar, David spent 15 years with MetLife and co-founded their structured lease group in 2007. He led MetLife's entry into aviation or airline bonds in 1997. David's also worked in a number of other firms, including ICF, Structured Finance International, Nomura Securities, and Lazard Frere Asset Management. David has degrees from New York University and Brandeis University. He's a chartered financial analyst and has served on both the ISTAT Appraiser Board of Program Board of Governors, a term with the ISTAT Grants Committee, and a member of the ISTAT Appraiser Program Exams Committee. He will be joined by Betsy Snyder, who is a director at S&P in New York. Betsy has a leading role in the credit reviews and ratings for the global transportation sector there. Betsy joined S&P almost 30 years ago, and that was after a 6-year stint with Merrill Lynch. Betsy is also a non-appraiser board member of the ISTAT International Appraiser Program Board of Governors. She holds degrees from Northeastern University and Fordham. Both David and Betsy will be joined by Mark Streeter, who is a managing director at JP Morgan in New York. Since 2000, Mark has led JP Morgan's transportation credit research team. He specializes in public aircraft debt markets and shares equity coverage of the public aircraft lessors with Jamie Baker. He is most recently rated as the #1 ranked analyst for both investment grade and high yield transportation securities. Mark is a non-appraiser board member also of the ISTAT International Appraiser Program Board of Governors, and he serves as a trustee for the ISTAT Foundation. Mark is a CFA holder as well and has degrees from Columbia and Boston College. Now, we would ask for our audience to please share details of today's call with your colleagues and industry contacts. You can find a growing library of presentations available for on-demand viewing at the ISTAT website, which is istat.org. And that includes some introductory sessions on EETC and aircraft asset-backed security markets that were recorded last September. They maybe provide some good background information for those unfamiliar with some topics discussed today. Now, please submit your questions throughout the session using the Q&A button at the bottom of your Zoom screen, and Jian will conduct the Q&A session at the end of the call, as I mentioned earlier. So with that, I'd like to hand things over to David to kick off today's discussion. David, over to you.
Thank you, Peter, and welcome to everybody on several continents this morning, this afternoon, and this evening. And Peter, thank you as well for the guidance in bringing this Learning Lab to fruition. Thank you as well to Bryce and Monteleone, who really planted the seed for this idea following our continuing ed session at the IAP at ISTAT in March. And thank you goes out as well to Mary Prettyman, incoming ISTAT president, for really encouraging us to move ahead and moving to this concept in today's format. I was going to call this really a fireside chat, but given the weather globally the past few weeks, I thought it might be more appropriate to have this more a little chat at the gate while we have an aircraft de-iced behind me here at the gate. So let's get to it. And let's begin maybe with some high-level thoughts on the capital markets environment for commercial aviation. We know commercial aircraft trading activity has been steadily increasing this year, but traditional capital markets debt activity has been fairly quiet. And by that, I really mean EETCs, ABS, and straight lessor unsecured debt. And maybe for some of those in the audience who may not be as familiar with EETCs, I would ask either or both of you just to briefly summarize EETCs. So we're going to start at a high level, and maybe Mark, let's just go with you first. We'll start at a high level and work our way down with a good, kind of two-way conversation with all of us.
Sure. Well, welcome everyone, and thanks for joining us. And David, thanks for moderating. It's great to be here with Betsy as well. Betsy and I were both in Farnborough on the tarmac for the hottest day in human recorded history, I guess, in London and greater England, last week, or a couple weeks ago now at this point. But so we made it through and we're recovering. But on the capital market side, there certainly is a recovery going on in terms of traffic, but for a variety of reasons, the capital markets have been very, very quiet this year. So I think it's helpful to just take a step back, right? So let's just start on the airline side. So the airlines, particularly in the US, which are most wed to the US dollar capital markets, certainly, they raised all their liquidity rescue financing in 2020, 2020, 2021, and entering 2022, this has been a year of traffic recovery, cash flow recovery, and because all that liquidity was raised, there hasn't been that much of a need for incremental capital markets issuance this year. Exacerbating that is the fact that Boeing and Airbus have not had their act together in terms of deliveries. And we know lots of reasons why: the supply chain, the situation with the MAX in certain markets, the 787, of course, which just recently got the green light for redelivery to occur. We've seen massive pushback in capital outlays that were projected for this year into next year. One example is United Airlines has CapEx now in 2023 that will be north of $9 billion, I think is their most recent guidance, in part because so much was pushed back. So that airline, for example, may be very active later this year or into next year, but that's really to fund next year's capital expenditures. So the airlines are sitting on huge liquidity hoards. Again, just to give you some US examples, right? United is at $22 billion in total liquidity right now. American is sitting at close to $16 billion. Delta, a very similar level. We just heard from Air Canada this morning. They're at north of $10 billion in total liquidity. So these liquidity hoards that many of these capital markets focused airlines have are at near record levels, at or near record levels. And that near-term call on cash is actually very minimal right now. Many of these airlines actually built cash from the first quarter to the second quarter, because you also have the phenomenon of the air traffic liability building up, right? And for those that aren't familiar with the air traffic liability, that's sort of promised future travel, your deposits as customers, right? A lot of us have been giving the airlines a lot of money as we book holiday travel and work travel further out the curve. Because don't forget, during the COVID experience, when the world shut down, we had this huge run on the bank with the airlines where all of those deposits were returned. And that's a whole nother discussion about liquidity management and so forth. We'll save that for a minute. But before we move on to the lessors, and I'll let Betsy chime in here too, David, to answer your question on EETCs, I think it's important for those that aren't familiar to just take a step back and think about how an airline can finance an aircraft purchase, right? EETCs is one specific product. That's basically, recourse secured financing, right, on a pool of aircraft that gets thrown into this EETC blender, and you have tranches and so forth. And it's an effective way to take an airline's very low credit rating, and through the magic of tranching and subordination, get much higher credit ratings from Betsy and her colleague Phil or the other rating agencies that are out there and so forth. But that's only one way to finance aircraft. You can also buy the aircraft. You can, of course, increasingly do operating leases, enter into operating leases for aircraft. You can raise private debt, bank debt, et cetera, to buy aircraft. So there's really a menu of about 6 frequently used options to bring aircraft into a fleet. EETCs is only one tool in that toolbox. And Betsy, why don't you chime in on airlines before we go out into aircraft lessors?
Yeah, I just want to say that in light of what you said about United, their capex is going to be much higher next year because of the delivery delays. Southwest, when they reported their earnings, they talked about the fact that they were originally supposed to get 114 maxes this year, and now it's only going to be 66. So another example of capex being substantially below expectations this year, and thus less need for debt financing. Now, I do want to also, can I take over for the lessors now, Mark?
Absolutely.
So there has been no activity on the lessor side since pre-Russia. There were a few transactions that were done January, February of this year, and nothing. But then Russia came at the end of February, and there have been no transactions done since then. Now, having said that, the aircraft lessors are in relatively good shape in terms of their debt maturities. They also did a lot of debt financings or refinancing 20 and 21, and they were able to raise a lot of financing. I mean, look at AerCap and their acquisition of GCAS last October. They raised $23 billion of capital markets transactions. And so they're in pretty good shape coming into this. They've extended their debt maturities, and also the financings that they did were at record low rates. I remember Air Lease did one that was at 0.7%. So they were in good shape going into this. But they're also benefiting from the fact that their capex is way below expectations as well, like the airlines. But at some point, they are going to have to go to the capital markets. They do have some pretty big maturities. Some of them have some pretty big maturities coming up in 2023. Now, I did hear in speaking to some of the lessors in London that the banks are open. The banks are offering term loans. They're on a secured basis, but they do have that potential source of liquidity should they need that. Now, and also, since most of the lessors' assets are unencumbered, they still have a big cushion if they were to raise some secured financing. That wouldn't be an impediment to their ratings. So I think we're all waiting to see who's going to go first. If you recall, in 2020, AirCap, when COVID hit, AirCap was the first one to go to the capital markets to raise some financing. They paid a high price for it, but they were able to access the capital markets. And I believe the next transaction that they did later that year with the pricing was about half of what they went out with first. So I think the thinking is that AirCap, Air Lease, one of the larger lessors who accesses the capital markets frequently, will have to be first to go. I don't know, Mark, do you have any additions?
Yeah, well, let me just give a couple data points here for the audience, just to get some perspective here. I mean, the airlines in 2020, just again, talking in US dollar terms, and we're not going to exclusively make this US focus. We have a very international audience here, but when we talk about the capital markets, the US capital markets is the deepest pool of capital out there. So just looking at US dollar capital markets, the airlines in 2020 issued just under $50 billion. That was a record amount of capital markets issuance. Interestingly enough, a year later in 2021, the lessors issued right around $50 billion, just under that. That was in part because, as Betsy said, you had AirCap funding the GCAS acquisition. So that's sort of the high water mark for both markets, just under $50 billion. And of course, we have a pittance this year. One other thing to keep in mind is the entire EETC market right, is only $30 billion. I mean, that's basically what AerCap raised to fund GCAS, right? So we're always telling investors when they ask us about EETCs, well, what are you doing on the leasing front? And have you figured that out? Because there, the amount of bonds outstanding is about 3.5 times. There's basically 100 billion and change of US dollar leasing bonds outstanding, right? So that opportunity set in what the lessors are doing in the capital markets dwarfs what's going on in the EETC market. And just in terms of EETCs annually, again, the sort of run rate is anywhere between 4 and 8 billion, something like that, not much more than that. And we can see double or triple of that out of the aircraft lessors on a regular basis when the pipeline, if you will, when the pipes are unclogged. Right now, they're still clogged, right, with those supply chain disruptions. And the other thing I'll just mention on the lessors too is, as Betsy sort of implied, they raised so much liquidity and were so active in refinancing debt early on in COVID. They also pushed all of their order book to the right. Okay, in part because Boeing and Airbus were allowing that because of the supply chain difficulties, but they were also scared of what was going to happen with COVID and demand. Right now, they're in the process of trying to grab all those airplanes and bring them forward as much as possible, right? But the delivery slots aren't really there because of the supply chain issue and so forth. But the demand is showing up, which is why we're increasingly talking about a shortage near term of single aisle aircraft and even potentially of twin aisle aircraft, although we'll get into a discussion, I'm sure, about supply and demand a little bit later, but that's what's going on right now with the lessors.
All right. Also, I don't want to leave out on the ABS market too. I mean, obviously, there have really been only 2 issues this year. One was a business jet deal. The other was a Carlyle deal, which only issued an H tranche and had tightened, much more tightened covenants. Thoughts there in terms of access to the market and prospects into the second half?
I can talk about that a bit since I work with our ABS analysts. We did rate the business jet transaction, and that was I forget what the time was on that one, but the other one was the Carlyle transaction to finance their acquisition of AMCK, and we did not rate that one. And from what I understand, the pricing, they were initially supposed to go out multi-class transaction. They tightened it up. Right. They just issued one. It was at a very high rate of 6%, I believe. And the LTV was very low. I believe it was 65%. So we have had some interest from some of the other names that you've seen in this space before, but things are kind of on hold because nobody wants to go out with those kind of terms. Right. And so, especially if they have warehouse facilities or other forms of financing. So everyone I think when conditions improve, I think you'll see some more of these, but until we see some evidence of that, I think everyone is kind of wait and see. The other thing too is that from what I understand, there's like non-existent equity available either. So that's another constraint. But hopefully things will pick up there. And we haven't really, these have been used to finance acquisitions or portfolios or other companies, which you saw with the Carlyle acquisition of AMCK. Carlyle did a transaction last fall for the acquisition of Fly, and the terms were certainly much more lenient. So, but what a difference a few months makes. And so I think that market hopefully will return, but there has to be some evidence that the terms won't be as onerous as they were for Carlyle.
Right. I think the good news, David, for the ABS market is that, traffic always returns. We know traffic is going to return to at or close to trend worldwide. And we're seeing that in every single market where the impediments to travel have been removed, fallen, et cetera. Traffic has been snapping back faster than anyone thought. Now, we've had more variants than anyone thought, and we've had re-lockdowns and so forth, right, which have sort of masked the pace of recovery that we've seen overall in so many of these markets. So that's the good news from an aircraft ABS perspective, right? The bad news is, and hopefully peak defaults are behind us as well. You know, transition costs, it's very expensive, right, to transition aircraft and so forth. So to the extent that you can keep aircraft within the same operator, even if you have to take a haircut on rent near term, right, those rent haircuts will roll off. Lease rates are improving and so forth. And we will see the debt service coverage ratios on aircraft ABS deals improve. But you run the risk, of course, in all these deals of extension risk. That's really what you're dealing with here.
Right.
And of course, some of the returns further down the stack, of course, get very impacted by that delay in cash flow and extension risk and the like. But importantly, with the ABS market is the grease that makes the global sort of aircraft ecosystem hum, all 8 cylinders, or however we want to describe it, as efficiently as it can, right? In order to have a maximum efficient market out there, you want the ABS market up and running, because that facilitates portfolio trades down the spectrum, right? From the air caps and the air leases and the Avalons, et cetera, down to the next year, to the next year, to the next year, right? Aircraft ABS increasingly becomes a tool as you sort of move from the largest platforms down to the smallest platforms, because those very small platforms tend to rely on ABS funding much more so than they do the more generic sort of recourse capital markets and so forth. So, you know, we're certainly hoping that the ABS market gets back up on its feet. We think it will. We think it's going to take time, and we think terms and return hurdles will adjust. But I don't think the ABS market is going away for aviation.
And Mark, I just might add that I think investors have been spooked by some of the portfolios or some of the transactions that have large Russian exposure. And so I think that investors are going to be looking more at the airlines and the regions that are in these portfolios going forward. I think they're going to be much more discriminating.
Yeah, actually, I was going to jump to that a little bit later on. I want to circle back with that later. A couple of things I want to get to here first in terms of pricing. If you look in the context of where we've come generally in the corporate markets so far this year, if you look at the challenges, 2 years into COVID, as you said, we're now 6 months into the Russian invasion, and you've had the inflation run up this year with central banks, notably the U.S. Federal Reserve tightening. What that's meant for particularly for, again, going back to double ETC markets or lessor markets in terms of spread widening, in the context of corporates, where, to give the audience a feel for where spreads are now and what the action has been.
Yeah, interestingly, David, it's sort of the opposite of what you would expect. The higher quality rated paper has lagged more than the lower quality rated instruments. So in other words, high yield aviation, if you're looking at the loyalty bonds or the routes, slots, and gates secured bonds, or even some of the unsecured bonds for some of the high yield rated airlines, that is actually held in a little bit better than the BBB and higher rated investment grade aircraft leasing space, or on the high quality spectrum, the double ETC market as well. So to give you some perspective on the lessors, again, which is sort of the more liquid side of the market, 5-year credit spreads, I'm looking at my sheet right here. 5-year credit spreads, BBB 5-year credit spreads year to date are out about 78 basis points. If you look at the benchmark 5-year bonds for the lessors that are active in the US dollar capital markets, the performance of 5-year bonds, Bank of China Aviation, only out about 10 basis points. They've actually held in very well because of a China technical. There's not a lot of Chinese investment grade bonds outstanding, so no one's selling those. Everyone's hoarding those. They're an anomaly. If you look at everyone else, starting with Air Lease, their spreads are out about 80 basis points. So they're kind of on top of the market, but then you go to an AirCap, sort of the same thing, believe it or not, at the end of the day, but at the BBB minus or lower end of the BBB spectrum, you've got names like Avalon Aviation Capital Group, Aircastle, that have widened materially more than the market by 50 basis points or so more than the market. We've seen a lot of pain in those mid to lower triple B names that are privately held, even if they're held by strong financial institution parents like Aircastle and Aviation Capital Group. Those two, for example, have really seen their bonds underperform. But in high yield, if we look at some of the loyalty debt or that route slots and gates debt, I think it's also been helped by the fact that Delta has been out there buying back bonds. In their case, and then American and United are also throwing on the board. United, for example, $22 billion of liquidity, even though they have this massive CapEx coming up. People are feeling very comfortable, of course, with their liquidity profile because of that. And even American, where they were able to maintain flat liquidity for the last several quarters here, close to that 16 billion amount. We've actually seen their bonds, all things considered, hold in better than some of those lessors.
Yeah, but I would also add, if you talk about the lessors, I think Avalon's situation is unique because they have this overhang from these holdco bonds ahead of them that are, what's the pricing these days, Mark? It was
20-something%.
So I think their situation is unique. But then you look at some of the other aircraft lessors that are out there, the non-investment grade, and those ones have not performed well at all. I mean, look at Fly, and there was what was the other one? I don't know what Voyager is trading at these days, but these non-investment grade aircraft lessors who have debt outstanding, their spreads have really widened.
Yeah, you're exactly right from the standpoint of there's such one-off issuers and so forth, but yes, you've got three basically high yield lessors that trade at least a touch. Castle Lake is trading, just inside of 10%. You've got these Avalon Holdco bonds, global aircraft leasing company, that's trading in the with a two-handle 20-something%. And the Fly leasing bonds, my goodness, those have fallen out of bed. Those are trading at a 50 some odd dollar price, yielding almost 38% right now. And you have Old Apollo Aviation, which is now Carlyle, who not that long ago put in fresh equity to buy Fly, and yet the market is clearly worried about whether that equity is whole, right? If the debt is trading at such a massive discount. But I will tell you, none of these companies are helping themselves from the standpoint of there's really a lack of information and a lack of communication for a lot of these. Fly is not talking to, or the Carlyle folks are not actively talking to a lot of folks. Castle Lake's a privately held, obviously organization. You've got these Avalon holdcos, which the H&A folks in the trust that controls half of it in China and so forth aren't talking to investors about this. So when there's uncertainty, that leads to mispricing, right? Where there's a lack of communication and a lack of transparency in a tough, choppy market, right? Investors go to sort of the lowest common denominator, which is wider and wider spreads and yields. And that's something that's exacerbated those situations, Betsy, that you're referring to.
It'll be interesting to hear what, I guess Air Lease is reporting their earnings later this week, and then AirCap next week. So it'll be interesting to hear what they have to say on what kind of guidance they provide, and hopefully that helps bring in some of the spreads.
Yep. And, on that note too, just on the strategic side, I've been asked kind of over the past few months, given kind of what we've seen in the equity markets and so on, is there capital still flowing, into aviation? And my answer has been, oh my gosh, absolutely yes. And in particular, it almost seems like there's been an acceleration this year. And just, by way of example, you've seen announcements, from a new fund by KKR. You've seen a recent Avalease announcement. You've seen things, entities like Ashland Place. So it occurs to me, and I'm curious of your thoughts on, is this do you see this as additional capital, or do you see it as possibly almost like a disintermediation taken away from what we have seen as kind of traditional sources in the kind of capital markets instruments that we've been talking about thus far?
I might also add the rumors yesterday about Apollo buying Atlas, which I find interesting. I don't know, Mark, if you have anything to say on that, or you can't because you're because of the bank's role in this. But I think that's pretty interesting. But then, I think private equity has been a factor for many years. It's nothing new here. If you go back and you look at, we talked about Avalon, they were initially owned by private equity. Then they did the IPO. Then they did they go back to private equity after that? I forget. But anyway.
After they did the IPO, they sold themselves. H&A. They sold themselves to H&A at 1.6 times book value.
Yeah, and then you have the other Apollo, which was bought by Carlyle, and then KKR and their acquisition. So I don't think there's really anything new here. I think private equity has been involved for some time. And you look at, what is it? I always get them mixed up, Oak Hill and Oak Tree, but they've owned some of the other aircraft lessors, as well as is it Sun Country that they own? So there's so anyway, I don't think there's anything new here, and I think they have a lot of capital. They don't have much in the way of deals out there these days. So I think aviation has been a very attractive space for them, and I think it will continue to be.
David, here's a quick rundown from a page we have in our mid-year outlook. Apollo owns Merck's, Ares owns VMO, Bain has partnered with Griffin, Carlyle has Carlyle Aviation, old Apollo, Carval has Ergo, Davidson Kempner is some of the money behind Ashland Place, Fortress with FTI, and before that, Aircastle, of course, KKR with Altavair, right? So, private equity and private capital has been part of this industry for quite some time, as Betsy laid out. And, we're looking at just taking a broader step back for those of you that might not be aviation focused, but, may be focused just on the capital markets in general. What we've seen in just the high yield market is private credit replacing traditional Wall Street high yield capital. And there was a point in time where, private credit for years was sort of always more expensive than the public high yield market, but then it flip-flopped earlier this year, where private credit was actually available on tighter terms than the overall high yield market. And it's kind of finding its balance right now, so to speak, but the growth in private credit is huge. Brigade just hired one of my colleagues last week, who was one of our originators or capital market structuring folks on the private credit, on the high yield front, to basically go run their private credit operation. So, we're seeing talent move, we're seeing focus move into that private credit world. So, and this is exemplified with all these private equity sponsors investing in these platforms. So, aviation, to me, I go back to what I said a few minutes ago, right? Which is, we know traffic is going to grow. That is literally a certainty, right? Based on everything we've been to, no matter what you throw at this industry, we know traffic is going to grow long term. It's just a question of what that trend is and so forth. And that's very powerful to a lot of people that are able to invest with that sort of long-term view.
And also, I might add that these are global assets. They can be moved around the world if redeployed to other parts if traffic is weak. The only time that this was not the case was when COVID hit and global airlines were shut down around the world, or they reduced their capacity around the world. But that was the only time. Other than that, there's been times when traffic growth might have been weak in one part of the world, but it's strong in another part, so you can redeploy assets there. So these are global assets, unlike factories that can't be moved. So I think
Right.
that's a positive for this space as well.
Right. Okay, so I want to move on more to the credit side here, and I certainly, like you said, I don't want to sound too U.S. centric here, but we have had kind of a fresh earnings in the second quarter here from most of the majors on the U.S. side, and I want to step back here. At the beginning of COVID, we had no major U.S. carriers file, but we did have ample liquidity come from the U.S. capital markets, such that there was quite a bit of debt raised in a number of forms, both with some U.S. assistance as well as other types of security, like both Mark and Betsy mentioned, in terms of soft and hard assets. So we got to the point where you had an effective doubling of gross debt among the airlines, according to Bloomberg. And so, I guess my question is, when you've had a recovery, it looks like, in terms of EBITDA in the past 12 months, but you still are certainly not up to pre-COVID levels in terms of profit margins and EBITDA margins, so that you're still you have leverage in excess of 10 times for most of the carriers. Where do we go? What's kind of the prospect in terms of deleveraging, in terms of timeline here?
Okay, well, I'll go first. So we have mostly stable outlooks on most of our airline credits. We've, unfortunately, well, the revenue side has been pretty strong. Obviously, fares are up and traffic has rebounded, especially on the short haul leisure side. There's still some concerns about business traffic and when that's going to recover. Now, we're also somewhat concerned with the economic picture, what happens after the summertime with demand.
Mm-hmm.
You have inflation out there, you have higher interest rates, so less disposable income, because that's really what's been driving this resurgence in demand for airline traffic. So we have questions about how sustainable this is, but then you also have a lot of cost pressures and so you have higher fuel prices, which everyone knows about that, and so far the airlines have been able to pass along pricing in terms of raise their prices to cover most, if not all, of this. But then you also have higher labor costs, and you just have all kinds of cost pressures. You have a lot of these airlines have they've had to cut capacity because they just don't have the airline infrastructure, that they don't have enough employees there. There's been air traffic control delays. So there's been all kinds of cost pressure here. And so that's hurting the profitability. And this is true in the US as well as for the European airlines that we rate. So I was just seeing this morning that Heathrow and Schiphol are actually cutting back even more on
Right.
some of their flights that they're allowing in. So obviously you have fewer seats that you can spread the higher costs over. So that's not a good thing. And so profitability, while things are good on the revenue side, they're not so good on the cost side. And so profitability is not as strong as we had expected. We think that it's going to be, assuming everything goes according to plan, that profitability, it could be another year behind where we thought it would be when it's going to be recovering. So that's obviously having an impact on leverage, because the earnings are lower than expected. And the debt remains high because, as we said, that they raised all this capital, and they haven't, while there's some natural amortization of the debt each year, the airlines are still keeping pretty strong cash positions just to weather any potential storms. So we think that leverage is well, it's going to be coming down somewhat, although you do have all this capital spending that Mark referred to, that it's going to be any recovery in terms of credit metrics is probably going to be longer than we expected. So therefore we do have stable outlooks for the most part on, I mean, keep in mind that we did do several downgrades during COVID. So ratings are lower than they were, and we don't expect them to recover to pre-COVID levels for many years, but at least for now, they're stable.
Mm-hmm.
Let me just give you, David, a couple of numbers here, right? So one of the analyses that my partner Jamie Baker and I did was really look at industry revenue in the US relative to GDP and where industry revenue should be based on the historic relationship. And as of sort of earlier this year, there was still $50 billion of revenue that was missing, right? That was the difference between where industry revenue production is as a percentage of GDP versus that baseline. And that baseline typically is around sort of 1%, a little bit less. But we were still only sort of at 60% of where we should be. Now, we're not going to get back that 50 billion in revenue immediately because there are constraints on pilots, right? The airlines, there are airport constraints, air traffic control constraints, and this is something that is global, not just a U.S. phenomenon. So, but that's just to give you some perspective on the U.S. numbers here. So there's still a huge revenue recapture opportunity as we move back to trend, but it's going to take some time to capture that. Now, in terms of leverage, sort of Betsy mentioned all the debt taken on and so forth, and it's true. Leverage metrics, I'm looking at a slide from my deck here, increased anywhere from on a gross basis from sort of anywhere from a half turn or so. Actually, one of the best in terms of their actual gross leverage increase was JetBlue, who's having their conference call right now, except they're going to pretty significantly be levering up to pay for Spirit. But their leverage only really increased a little over a half turn on a gross debt to adjusted EBITDA basis, which is what we like to look at. But then we saw, some other names like United, for example, increased 2.5 times, an American increased like 2 times, but that's on a gross basis. If we look on a net basis, right, the increase in leverage, I mean, Southwest has negative net debt right now because of their cash balances, right? So we have these huge cash balances, right? So part of the intellectual exercise is for everyone here looking at the health of an airline, whether you're looking at the credit or the stock of the airline, is trying to figure out how much of that cash, right, is true excess liquidity that can be used for debt repayment versus how much of that cash needs to be used to fund aircraft capex. Let's use United again for an example, $22 billion of liquidity, right? But $9 billion of capex and so forth. Then you have to look at, well, what's their operating cash flow over the next 12 months, right? Because it's not as if the $9 billion of aircraft have to come directly out of the $22 billion of liquidity. They are going to be generating operating cash flow. And
is the highest, north of $50 billion all in still.
Sorry, excuse me. I'm making sure that we're connected here. So just making sure with American, where we have a net debt balance or gross debt balance of over 50 billion, their current liquidity right now is $16 billion. They've been in a constant debate with their board and with investors about what is that minimum target liquidity? Is it, say, 10 to 12 billion, which seems to be sort of where they're landing. So that implies they have very minimal capex that they can easily fund through operating cash flow. So they have about, say, $4, $5, $6 billion of excess liquidity right now. So when do they go after, right, the debt stack and be proactive? We're already seeing Delta do that by using that cash to tender for bonds. So this is the type of analysis that Betsy and I are doing, that we're the type of conversations that we're having with the investors that are invested across the capital stack on this topic of debt, results, cash flow.
Well, and I remember after 9/11, a lot of folks looked at that as a percentage of, as liquidity as a percentage of revenues. Is that something that folks like American are still looking at, or is that, are we looking at a different metric now?
I would say we're looking at more debt to EBITDA than the and FFO to debt than that cash as a percentage of revenues. I mean, we haven't really seen that much, but you're right. That used to be the
Or should
metric
we?
that everybody focused on. It used to be what, 30% was a good level.
Right. That's right.
Well,
That's right.
It used to be, rule of thumb was 10% was bankruptcy death watch, and 15 to 20% was fine. 30% was really good, Betsy. We were never like holding anyone to a 30% standard, but that obviously that metric has a lot of flaws, right? Because again, depending on where you are in your CapEx burden and so forth. I mean, listen, I like to use the example of American Airlines has 50 some odd billion dollars of debt for two very good reasons, right? Number one is they refleeted well before United and Delta refleeted. Number two, they also wouldn't have bought back $15 billion worth of stock, right? So, part of it you can understand, part of it was self-inflicted. That's why they ended up where they are right now in terms of their, debt burden, right? So context is very important for all of this.
Yeah. Yeah.
And I would say on the lessor side, during COVID, we did revise some outlooks to negative, but we ended up revising them back to stable. So we, for the investment grade lessors, they ended up maintaining their ratings. Some of the smaller ones got into trouble, the ones that had upcoming debt maturities that they couldn't refinance. And they did, and their assets were encumbered like Voyager and Aviation. But other than that, the lessors pretty much kept their ratings. And we do, even with the Russia situation, with these very, very large impairment charges for some of them, we did take a look at those, and we actually affirmed all the ratings as well for the, that we look at debt to capital or debt to equity as one of the credit metrics that we look at. And while the equity took a hit, we still think it's that the ratings can withstand that, and probably a return to some of the expected credit metrics are going to be a year out. But with the lessors, some of them are very vocal about their leverage targets, and if they don't maintain them, then we would certainly have a look at them. But so far, even with COVID and with the impairment charges and with the lease restructurings and all the bad stuff that's happened, the ratings for the most part have been maintained.
Well, Betsy raises a very important point here, right? Because think about the airlines. The airlines saw 80% of their revenue, 80% plus, walk out the door, right? When COVID hit. For the lessors, that was really only 30, 40%, something like that, right? And then you look at the recovery back to 100% revenue or collections, right? And it's been much, much faster for the lessors. The lessors weren't downgraded, the airlines were. The lessors have their debt equity ratios right back to where they were, if not better. But the one metric that's lagging is their FFO to debt, right? Or their cash flow generation, however you want to measure that. But that will catch up, especially with lease rates on the move higher and so forth, and collections now in many instances exceeding 100%. But it just sort of highlights the fact that, and this is something I think investors miss, the leasing model is much more resilient than the airline model, the airlining model, because you don't have to deal with the exogenous shocks to the same degree that they hit airline financial statements. The lessors just have, through the benefits of diversification, right, just more cushion. And it's something that I think investors, especially because we're dealing with two different sets of investors. A lot of times airline investors are traditional sort of transportation industry investors, and aircraft leasing investors oftentimes are financial institution investors that are more used to looking at other FinCos and FIG related names and so forth. And these investor bases come at the industry with very different perspectives.
Right. So just to be clear then, from both of you then, when you look at the write-offs at the major lessors at this point, any recoveries that might happen on the insurance side would just be gravy?
Yeah, from our perspective, yes. We have not included any potential recoveries. We don't know the timing. We don't know the extent. We've been speaking with our insurance analysts, and there's still a lot of uncertainty as to when these might happen. We do think that there will be some recovery, but we just don't know what. But as you said, this will be gravy to them.
There will be a recovery. I remember early on in the Ukraine crisis, representative from Lloyd's of London basically said, we know there are claims. We just don't necessarily know how to calculate them and the timing and so forth. And I'm of the view that the insurers are going to continue to kick the can down the road, hoping that at some point there's a relaxation of sanctions and so forth. And then they can sort of unravel, where do these aircraft go? Do any of them go back to the lessors? Is there any reunification, if you will, out there? Or are they simply all going to be, released and reset within Russian airlines and owned by insurance companies, whatever? That's really what needs to be figured out here. But there will be recoveries, either through the insurance companies or through some sort of reclamation, if you will, of value. That we know for sure. The answer is not zero on $10 billion worth of aircraft that the industry wrote off. But no one on the equity side, no one on the credit side, on the investing side, no one on the rating agencies, right, is factoring in any sort of recovery whatsoever. So it's a nice surprise down the road whenever we get there. That's the way to think about it.
I agree.
Okay, good. And I want to keep an eye on the clock here. I want to get to ESG a little bit here. It is a topic that has been growing more and more among issuers and investors here. And one of the questions I think we should talk a bit about in terms of where you see the impetus. Do you see the driver of the ESG component in new issuance more from investors or from issuers or both in the aviation side right now?
Well, since we're saying that there hasn't been much in the way of issuance.
Notwithstanding the light calendar, but yes.
I mean, we saw British Airways, IAG, through some of their subsidiaries, pursued 2 EETCs that had a sustainability component with key performance indicators, key performance metrics that they would hit, CO2 per seat mile reduction, predetermined targets and so forth. And if they don't hit, then, coupons step up and the like, right? So we've seen some of the more progressive international airlines, no surprise, out of Europe, pursue this. We haven't really seen much on the leasing front. There's been a couple small sort of private placement deals done, but none of the big capital market issuers have pursued anything yet in terms of green related bonds and so forth. We did see Air Lease in partnership with Airbus as part of an aircraft order, seed the establishment of an ESG fund really focused on sustainable aviation fuel. We saw Aviation Capital Group jump in on that. We also saw Aviation Capital Group in partnership with ISTAT, which was nice to see, establish a diversity and inclusion initiative, which is the often forgotten part of ESG, right? So it's not all about carbon and carbon footprint. There are other aspects to sort of the ESG mandates that are out there, and Aviation Capital Group, nice to see them pursuing that. We've seen Avalon through their Avalon E subsidiary and their investment in EVTOLs. I had the chance to sit in one of their, vertical prototypes at the air show. Super cool. If anyone wants to see a picture, text me, I'll show it to you. But that was really neat at the air show. And we're starting to hear more and more about, the pathway for those EVTOLs to come to market. And a lot of the lessors are thinking about that. United Airlines has been investing in one of those platforms as well. So it's growing, but it's slow. And we know investors want to see more. And we know the industry has, net zero carbon targets and so forth, that we need a lot of work to get there. One question I often ask investors is, what's the difference in CO2 emissions from, pick your generic, GE, CFM, Pratt & Whitney engine flying at 30,000 feet. One side of the wing's engine is burning dinosaur fossil fuel. The other engine on the other side of the wing is burning, sustainable aviation fuel. What is the CO2 footprint difference in the air? I shouldn't say footprint, but just emissions difference in the air. And the answer is basically nothing. I mean, they both emit the same CO2. A lot of people think, well, if you're burning sustainable aviation fuel, it doesn't emit CO2, but that's not the science. Like, look into it, okay? Because all of that life cycle savings from sustainable aviation fuel is how it's grown with sunlight and transported on trucks that are using electricity and so forth. It's not from the actual burning of the fuel. So I mention that because it also just highlights how big the problem is, right? Why we need to get away from, fossil fuel and sustainable aviation fuel into either batteries or hydrogen or something like that, that simply stops emitting carbon in the atmosphere. Because until we move away from that, it's going to be incredibly difficult for this industry to really reduce its carbon footprint.
But those developments are so far into the future, Mark. Those alternatives.
A long way to go. Betsy, we probably won't see them, at least as practitioners, right? Some of what we're talking about here, commercially viable hydrogen-powered aircraft and so forth, right? I mean, we're talking decades for the pathway for some of these technologies. We will see eVTOLs. Those are coming. So David, investors are playing the long game here, and I think issuers across the board and bankers are trying to figure out how best to meet this demand and meet the demands that the shareholders in these companies are having.
And David, I would just add that I think this is a real positive for the aircraft lessors, because as Mark said before, there's a shortage of aircraft, or a shortage of narrow bodies. And as far as, so the airlines themselves want newer technology aircraft, certainly more fuel efficient aircraft. Right. And then with a lot of these ESG concerns that are out there, the lessors have the large order books for these types of aircraft. So I think it's really going to help their demand equation going forward. Right.
Okay. And I also want to, you touched on this briefly, I mentioned Atlas too. I mean, certainly the demand during COVID for freighters has been strong to, I'm curious to what extent you guys want to talk about the flow of activity or interest in financing for freighters in our markets.
Well, we rate ATSG, which is primarily domestic, and then we rate another global, Western Global, which is more international. I am getting concerned that there's going to be too much overcapacity in this space. You have a lot of new entrants. You have a lot of orders for freighters. And while things are looking great now, the freighter industry had tended to be more cyclical than the passenger industry. Over the years, we've seen a lot of bankruptcies in this space, going back a long time, but even more in 2000, I can't remember the name, but well, you had Evergreen and you had some others, but I'm getting concerned that there's too much capacity coming into this space over the next few years. So time will tell. But anyway, Mark, do you have anything to add?
Air Canada this morning announced a new 777, factory freighter order. So they're bulled up on their opportunity. Ordering, brand new factory freighters is something we don't see every day from passenger airlines. They're placing their bet.
And the other thing, during COVID, a lot of the aircraft were grounded, certainly the wide bodies that have belly capacity. And now that those are coming back into the system, that they're flying again, there's even more capacity being added. So as I said, I'm getting somewhat concerned about overcapacity over the next few years.
Okay. And one final topic I want to make sure, we are, of course, global, as we started off saying. And when we look into the second half and we think about regions globally, what comes to mind here is that, one of the big swing factors has been in the past is China. And now China, from a travel perspective, has opened up again. We've had, these lockdowns now a couple of times. in major cities in China, and now we're starting to see travel come back. Do you see any surprises there in the second half, either in Asia or China or other parts of the world in the second half that that could be either significantly to the upside or downside that we should look out for?
Well, I would say outside of China, from what I'm hearing, Asia Pacific is returning to more normal conditions, certainly catching up with the rest of the world in terms of demand. China's certainly a big question mark. I think over the long term, I'm not concerned about China, but how long are these lockdowns going to continue? And apparently, with the lockdowns in China, even domestic traffic has been impacted as well. So it's a question of what the lockdowns have, when the quarantine periods end for incoming and outgoing traffic from China. But I think over the long term, China is certainly here to stay in terms of demand.
Well, I'll say a couple of things on China. So number one, as someone who has had 3 COVID shots and has had COVID twice, including on the heels of the air show, my most recent bout, which was very mild, but still, I tested negative or positive for 7 days afterwards, after showing symptoms and so forth. I think a zero tolerance policy is never going to work. Mother Nature is going to win. And I think most in the West certainly realize that, and we've seen the countries that have capitulated and gone away from a zero tolerance policy and so forth are showing moving on more quickly. So that's always the risk with what China's pursuing right now. You also have headlines today. I mean, Nancy Pelosi is visiting Taipei, Taiwan, Chinese Taipei. And so we have the issue of the political risk, relating to that. And so, I'm often asked, could China be the next Russia, Iran, and so forth in terms of the way the West treats it and so forth? I don't think so. I think China's too big. I don't think that will happen. I think rational minds will prevail in terms of these geopolitical tensions and so forth. And China, if you just look at the recently revised Airbus forecast or Boeing forecast, you look at the growth that China and Southeast Asia represents, it is still significant. Sorry, phone ringing here.
And don't forget the big aircraft order that they just placed with Airbus.
Right.
For what, almost 300 aircraft recently?
Absolutely. So when you think about, when you just think about the role that China needs to play for the lessors, for Airbus and Boeing, keep in mind that their own domestic production of aircraft it's going to be decades. It amounts to any sort of viable substitute and so forth. So we have to have relations with China from the manufacturing front. China traffic and the China market and the Southeast Asian market is going to continue to be, one of the biggest sources of growth, short, intermediate, long term for the sector and so forth. And I don't think we're going to end up with a Russia type situation in China as well. But it's interesting because we've spent a lot of time asking the leasing management teams about this and who's open for business in China, who is being more cautious and so forth. And you've got AirCap very much open for business. They're the index. They kind of have to be. Avalon very much open for business. Now they're 70% owned by the Chinese, right? And you've got a couple of management teams like Air Lease who is exhibiting or speaking a little bit more caution, right, about China and managing their exposure just to be safe. So this is a topic, David, we're going to be hearing more about, spending more time with. It's something definitely for investors to consider, but we're not fixated on it. We're not worried about it.
All right. On that note, we are at the top of the hour here. Mark and Betsy, thank you so much. You've been very generous with your time. I think we've covered a lot of ground here, a lot of air and nautical miles here. So I am going to hand it off to Gian with some Q&A. Obviously, there's lots of more good ground we can cover, but this is great. And hopefully we'll have some good questions from the audience. Gian?
Thanks, David, and thanks very much to Betsy and Mark for the very interesting discussion tonight. So we currently have a few questions in the QA list. So if anybody has any questions, please feel free to send through the QA button. So I guess I'll start with the first question from the audience. Could you please talk a bit more about like the lessons learned for aircraft ABS framework and assumptions? Do you expect any revisions to any of those?
Well, I mean, I'll make a few comments, lessons learned. I think I covered some of them. The fact that investors are going to be more discriminating about the airlines and the geographies that they operate in. And I think also probably aircraft themselves are going to become, I think investors are probably going to want newer aircraft and maybe more narrow bodies than what we've seen before. So I think those are probably the two things that I would cite. Mark?
Yeah, I would say obviously market concentration, customer concentration, cost of repositioning aircraft, whether it's single aisle or twin aisle aircraft, all of those have been gotcha sort of moments in the aircraft ABS market, right? You know, some of the deals when Ukraine and Russia happened, situation in Ukraine and the aircraft were trapped in Russia. I mean, there were deals that had 20% plus exposure to Russia, and the deals had allowed that to happen. Well, that was probably a bad structuring decision on the part of the bank that brought that deal to market. And there was probably a disservice done to investors there because they were not adequately protected. So investors, if they're smart, will demand that that changes. And what we've seen time and again is the cost of remarketing aircraft. Again, if they're single aisle aircraft, even there, it can be often exceeding expectations, but certainly on the twin aisle side, right? Especially if you're dealing with IFE systems and so forth, right? It's incredibly expensive. And a lot of these deals did not adequately account for that. And so there have been changes to the reserve requirements and so forth. So it's all a process, right? It's iterative. And you know, these deals tighten up. And then at some point, maybe the market's going to get frothier or return to the froth that we've seen before. And then we'll probably see deal terms maybe loosen up a little bit. And then someone will get burned and we'll tighten up again. So it's part of the natural evolution with these structured deals. I mean, we didn't really talk about some of the changes to the EETC template that's out there. And, you know, we've seen, you know, American Airlines' most recent deal actually put in place a couple of the changes that the Aviation Working Group suggested on the heels of some very aggressive sort of private equity tactics that we saw in some of the EETC bankruptcy. So we've even seen that product after all these years. Remember, EETCs and ABS, of course, have been around for quite some time now, but you know, you can still teach an old dog new tricks in terms of some of these bankers and some of these products. So the market will speak and will react in order to get these deals properly structured to meet investor return hurdles.
Thanks, Betsy and Mark. We have a next related question. The audience is asking, what are the differences between ABS and EETC and the main reasons for picking one over the other? I think we previously in the Learning Lab sessions, we actually have done specific sessions on ABS and EETC. So I would suggest the audience to sort of go back to our learning session recordings to take a look at those. That might help answer the question.
Yeah.
Betsy and Mark, is there any like sort of additional comment?
No, they're different. I mean, EETCs are issued by airlines and get all kinds of enhancements, whereas ABS are issued by on portfolios of different airlines, different aircraft, whatever. So they're completely different products.
Well, they're essentially non-recourse. So the big difference there.
David, that's the difference, right? EETCs are a recourse product and ABS is non-recourse. And to me, I've seen it in my real estate life between CMBS and mothership REIT bonds. I'm not going to go down this rabbit hole, okay? But what I will tell you is that the recourse aspect is underappreciated, and it's what saves your butt at the end of the day, and why the track record in EETCs is much stronger than the track record in aircraft ABS. So all else equal, right? The EETC ratings are safer, and investors know this, which is typically why for a single A to single A, triple B to triple B slice of double ETC versus aircraft ABS, you will often find in most regular way markets that the double ETC trades tighter in terms of yield and spread, because investors buy into the safety of the double ETC more than they buy into the safety of the ABS. But they are different products, but the main difference, of course, is that recourse. Let's leave it at that.
Thanks, Betsy and Mark. So our next question, let's say from a lessor point of view, what is a good IRR or a realistic return in this market, considering the interest rate is going up for different airlines, say tier 1, 2, 3, different tier of airlines?
Betsy, you want me to start with that one?
Yeah, why don't, that's a hard one.
This brings me back to something that I've said at conferences over the years, right? You know, and the one thing that's changed in my sort of 2 decades plus covering aviation, formerly as a sell-side research analyst, right, is the globalization of the industry. When I first really started, jumping into aviation over 20 years ago, it was still a very sort of localized, if you will, market, and global capital flows didn't have the impact that they have today. So, one of the reasons why we saw 0.5 lease rate factors, which multiply it by 12, it means investors were investing in operating leases at a 6% gross yield, right? And that's before leverage, of course. Mm-hmm. That was because they were borrowing at 50 basis points or 100 basis points all in, because they had very cheap Japanese funding or something like that, right? So you have to always factor in where lease rate factors are and where returns are versus that cost of debt. The question, of course, implies that the cost of debt globally is increasing. Absolutely, right? So you have to factor that in. You have to factor into what was going on 20 years ago was the risk premium that you attached to that was also much wider. And so we saw that risk premium narrow over time. So, but with the cost of debt rising, returns are going to need to rise. Now, you also have the impact of inflation on residual values, which you have to factor into that return equation. You have to factor in how much leverage is readily available and at what price. Can you lever a platform at 3 times, 4 times, 5 times, which some of these private platforms have been leveraged at, 5 times debt to equity, right? And again, so it all factors into the calculus and the optimization of where those return hurdles are. But are return hurdles increasing because of the cost of debt? The answer is yes.
Betsy, do you want to?
I would just say that lease rates are a factor of interest costs and demand. And I would say that with demand being so strong, what we're hearing is the lease rates are rising along with the interest rates as well as strong demand. So typically, unless interest rates jump up substantially and they can't recover them, that hasn't been an issue for this sector, for the leasing companies. So I'm not too concerned about rising interest rates for the lessors.
Mm-hmm.
So in terms of the type of risks involved going forward when it comes to warehouse facility financing for especially mid-life aircraft, what kind of type of risk will be involved, especially going forward?
So, I mean, warehouse facilities are typically put in place so they can be taken out through longer term financings through the ABS market or other types of financings. And with the market, with very little minimal capital markets activity recently, that might be the biggest risk that some of these, the banks are holding for these warehouse facilities, that they won't be able to be taken out because they're typically considered more bridge facilities that they expect to be taken out. So if the markets don't recover, or if certain aircraft that are in the warehouses are less attractive, that would probably be the biggest risk, I would think.
Yeah, my institution, we're not big into the warehouse lending business to the lessors for a variety of reasons. One reason is we've just never got comfortable with the return hurdles and so forth there. So it's not a market that we're all that active in, say the least. But I think Betsy's spot on, right? You know, these facilities, right, are there to be taken out with capital markets execution for the most part. And that's the risk, right? You run the risk of you know, just like any sort of bridge book, if you will, and these aren't quite the same as sort of a true underwriting bridge for, you know, a private equity, you know, LBO takeout, where you can have pricing fluctuate that much. And we're seeing that across Wall Street right now, but there's still there's that pricing risk in these facilities and that structuring risk in making sure that you have adequate controls and so forth. But the banks that do it know what they're doing. And they haven't been too burned by that business, is my understanding.
Yeah, and I would say also if the value of the collateral is less than expected as well, that the LTVs are higher than expected, that could be a risk.
Mm-hmm. Yep. Our next question is, do you think is there any near-term likelihood of another large lessor bankruptcy following NAC?
Well, what do you mean another large lessor? What was the lessor bankruptcy that you're referring to?
Well, I said other than NAC. NAC.
I'm sorry, I didn't hear that part. Okay, sorry about that. No, I think NAC was somewhat unique. I mean, we just rated them coming out of bankruptcy. I think they were somewhat unique. From what I understand, we didn't rate them before bankruptcy. They had a lot of secured debt. That what happened was they had a larger percentage of their customers defaulted than you see for the lessees with the lessors with the larger jets. And I think that's what really was their problem, the regional jets, the turboprops. And so they had, what did they have, like 50% of their lessees had defaulted, as opposed to a very small percentage of what we talked about before with the larger aircraft lessors. So no, I don't really see anything of that magnitude. I don't know, Mark.
They also had some fairly high concentrations too, which I think is a lesson learned too, but comes with the territory, I think, on smaller aircraft.
But you know what I find interesting, that there's some new startup regional turboprop lessors coming into this space, even after the NAC situation. Sorry, Mark, go ahead.
Well, no, I would just say, I mean, NAC had done a privately placed bond that one rating agency rated strong BBB. I don't think it ever paid a coupon and then, defaulted. So it was a tough situation for multiple sides of those involved. And Norm Liu is there now, who was brought in from GCAS. He's very well respected. They're actually trying to move away from turboprops now into sort of more mainline aircraft as well. So it's interesting that maybe that's the biggest indictment on the turboprop market, is that even NAC is trying to diversify away from it. So it'll be interesting to see how that evolves. But to the question of large platform bankruptcies, again, none of the large platforms even suffered any sort of rating downgrades. No one was even close to any sort of financial distress or anything like that. So no, we don't see it.
Yeah, I mean, it's interesting that one of the other lessors that got into some financial difficulty was Avation, which is another lessor of the regional turboprop aircraft. but that all, so it seems like that space was hit harder, but at the same time, as I said, I'm seeing some startups here in this space, which I find kind of interesting. Size
matters, right? I mean, Voyager was effectively, defaulted, and PIMCO and others took it over. And so, the old Intrepid, again, but 17 aircraft, right? Look at Avation, look at how many aircraft they had. NAC had more in terms of number of shells and so forth, but was still a relatively small platform. But these top 10 global lessors that are pursuing BBB ratings and an unsecured funding strategy where they have unencumbered assets to rely on, it's almost impossible to try to get one of these stories to truly default. If you reach that level of size and that level of unsecured funding, it's just, we haven't seen it through the GFC. We didn't see it through COVID. Obviously going back to the GFC, we had ILFC and AIG and so forth, but that was the Achilles heel really for these business models, which was borrowing short, right, and owning long, right, and having a run on the bank and so forth in terms of the capital markets. But what saved old ILFC was a completely unencumbered balance sheet that the government could just encumber, right, with secured debt, rescue financing, sell the platform, and move on, and you effectively never defaulted.
Yeah, and what happened with them was that they were able to, as you said, they were able to use those assets for secured financings that was able to take out the short-term CP, and then they stretched out the debt maturity. So rather than having they have billions of dollars of CP outstanding that they had to refinance, they were able to do that. And then as business improved, then they were able to take out those secured financings with unsecured debt. So I think that really was the model for what the aircraft lessors are doing these days in terms of their capital structure.
Yeah. And on the other hand, do you expect any M&A activities among the lessors in 2022, 2023 timeframe?
Well, we do have one out there now. We have SMBC acquiring Goshawk, which after months of speculation has finally been announced. I don't know. It's hard to say because you have this new entity, Avalise, that you mentioned, David, that has these big aspirations, and perhaps they could just buy one of the other lessors that are out there to reach their goal. I thought it was kind of interesting that they said that they want to have 100 billion of aviation assets by the end of the decade. And I looked, and Air Lease GCAS combined only has 55 billion. so it's going to be interesting if they become a participant in M&A to reach those goals. But out of the other ones that are out there, I don't really see much out of it used to be everyone thought that maybe some of the Chinese lessors would be acquired, but so far that hasn't happened. So I don't really see much out there. Do you, Mark?
No, it's funny. I keep thinking of Gus and AirCap, and he had his once in a lifetime deal, and then he had his twice in a lifetime deal. You kind of wonder, is there a third time in a lifetime deal out there for AirCap down the road as the major consolidator? But I think you're right, Betsy. Keep your eye on Avalise, right? Given their stated aspirations, that sort of implies that they're not going to be able to order enough aircraft from Boeing or Airbus to satisfy that. There's not going to be necessarily that much demand from, the Saudi, affiliated airlines, right? It implies basically by that statement that they're going to look to buy another platform at some point in time. And we don't know if they, obviously, I guess SMBC had Goshawk circled for a while, before they announced the deal, or maybe Avalise wasn't ready to get into the mix with Goshawk, or maybe that seller didn't want to engage for whatever reason. But to the extent that they could be involved, I mean, that's going to be something fascinating to watch. I think it'll be interesting to see if anyone else emerges, with a deep-pocketed parent, right? Because whether it's the Public Investment Fund of Saudi, the Kingdom of Saudi Arabia, or it's another financial institution that comes to market. I mean, Berkshire Hathaway, could they decide they want to get into the aircraft leasing business, right? Not saying Warren Buffett is going to, after his refusal to invest in airlines and then jumping in head first to be the largest owner of American, Delta, United, Southwest, and then dumping all those stocks at a loss. Probably not, but you never know when someone like that might decide to get involved in the sector because, especially on the aircraft leasing side, I go back to what I said probably half hour, 45 minutes ago, we know that traffic is going to grow. It is a certainty.
I mean, it could be one of the private equities who wants to expand its fleet. We talked about KKR and Merck's.
Yep. But I would
Can I
point
just,
out too,
sorry, can I just jump in here? We've got literally only a couple of minutes to go before we need to wrap things up fully. So if we can keep everything short and brief and try and be done by the bottom of the hour.
Okay.
I was just going to point out, if you look at the top, say, 25 global lessors, say 5 or 10 years ago versus today, it looks very different, except for maybe the top 2 or 3 lessors. I mean, there's been a lot of M&A that's already happened just even in the past 5 years. I mean, just take off Aviation Capital's gone to Tokyo Century, AMCK you mentioned is gone, Fly Leasing. A lot of the middle tier has already, a lot of it's happened already. I mean, you would need a fairly large new entrant to be the driver of that.
Well, that's what we said, Avalis.
Yeah, yeah.
Yeah, like given the time limit, we will just take the last question from the audience. And apologies for not being able to go through a few others. I think they're sort of like touched upon by Betsy and Mark during the discussion today. So the last question we will take from the audience is, what's your expectation around the tradability of aircraft assets over the next 18 to 24 months against the backdrop of rising interest rates? And if you think this is a limiting factor, what does that do to lessor valuation?
So you want to start?
Okay.
Or I can start.
No, I'll start. I think over the next 18 months, what we've heard from the aircraft lessors is trading activity has really picked up. And so, what was it? Avalon said the other day that they had LOIs for how many aircraft to sell. So I think trading activities really picked up. I think there's capital out there to acquire these assets. So I think, I don't think that that's a concern.
I think it's picked up somewhat, but I think for the industry to be firing on all cylinders, I go back to what I said about the ABS market. We need a more active ABS market because there is a whole host of players that right now are crippled. They're paralyzed because the ABS market isn't functioning as properly as it should. So that side of the market is still relatively closed. And when that opens up, that is going to make the whole ecosystem more viscous, if you will. The viscosity of aircraft trading will increase because it'll be easier to finance and so forth. So that's what I'm looking for, to really be bullish about how much trading activity we could see.
But many of these buyers also have warehouse facilities that they're using to finance these acquisitions.
And private equity.
Yeah.
Yeah, great. Thank you so much, Betsy, Mark, and David, for this very interesting discussion today. And thanks to all the audience for joining us today. Please note this session is recorded and it will be published on ISTAT website over the next 24 hours, same as all the previous recordings we've done on Learning Labs or ISTAT podcasts. They're all available on istat.org website. So we look forward to seeing you in our future ISTAT Learning Lab sessions. And thank you very much for joining us today.
Excellent. Thank you very much, everyone.
And thank you all. Okay, bye.
That concludes our call for today. Thank you.